welcome to Bull and Bear Education. Today's video is going to be on the common rookie mistakes of the stock market. So basically the common mistakes that you can expect from rookies or intermediate traders or even experienced traders, the mistakes that you want to avoid and the mistakes that happen due to, well, lack of experience or just simply not taking time to anticipate what the possibilities of your trades can be. Now, before we begin, just some important housekeeping things we need to take care of. Please understand that this is not financial advice, but this is for educational and entertainment purposes only. Investing in the stock market involves risk that can result in losing all or more than your initial investment. That depends on which asset you trade. Please ensure that you fully understand the risk before entering into any investment, and past performance is not an indicator or a guarantee of future results. You can receive financial advice from your licensed financial advisor, a financial professional, someone like that. That is not me. I am not your financial advisor. Thank you very much. All right. So when it comes to avoiding the mistakes that are common to the stock market, common to beginners in the stock market, it's important to understand that you need to monitor your behavior. And why do you need to monitor your behavior? It's because when you're trading, it's important to maintain that awareness, because if you're unaware of what's going around you, what's going on with you, then you're prone to make mistakes. So it's important to maintain awareness. When you're trading, it's not just financial skills that you need. You also need to know how to control your emotions. You need to know how to plan ahead. Taking a overall cerebral or calculated approach at things, not just flying off emotions. All right, it's a fine line between gambling and trading, and so you have to walk that fine line. If you're not careful, then you'll end up gambling, and gambling in the stock market tends to lead to losing. All right, so one of the most important, but one of the commonly underlooked aspects of trading is trading psychology. All right. Yes, there are algorithms in the stock market, but the algorithms are programmed by humans. And when they're not programmed by humans, they're ran by humans. And the humans ultimately can control the algorithms. And when algorithms are not responsible for a purchase or a sale of an asset, humans directly are. And as a result, there is a heavy dosage of trading psychology that goes on in the stock market. All right. So some of these things that you need to be aware of when you are trading from a psychological aspect are things such as the desire for even, off, or rounded off numbers, things like that. All right, so numbers that end with a 0 or a 5, a 10, 20, 25, 50, 100, 500,000. Those are things that humans tend to want. That's part of your trading psychology. Oh, I want to make $500 today. Well, you're sitting at $483 profit. That's pretty good. Don't push the envelope. Take that 483. But some people want to push for that 500 and they end up losing. All right. So those are things out of your trading psychology that you need to be aware of. Also, the desire to walk away or to end your trading session on a win. Let's say you had 3 wins in a row, or you won 3 trades early in the day, and then in the afternoon you lost 1, and you're like, you know what? I can't just stop now. I need to keep going until I get a winning trade. This is not Call of Duty. This is not Battlefield. This is not FIFA. This is not Madden. It's not a video game. You do not want to end the night on a win. It's not necessary. All right. There are real consequences to attempting to walk away with the win, and typically it leads to losing furthermore. And the reason that we mention trading psychology and monitoring the behavior of yourself while you are trading is because without doing so, there are severe consequences. Some of those consequences include losing some or all of your money, being unnecessarily frustrated, and possibly even becoming addicted to the stock market itself. And we don't want to do any of these things. So, how do we monitor behavior? Well, you can monitor your behavior through simple methods such as pre-planning your trades and sticking to your plan. It is very, very important to do that because it helps you control your emotions. In fact, it helps you get emotions out of the way. When you pre-plan your trade, you can eliminate the need for feelings. There's no need to feel anything because you're executing the trade that you planned. So you should always trade your plan. You should always plan your trade. Or you could do it in the inverse. You could always plan your trade and always trade your plan. What I do is I write down my trading plan before I trade it. If I'm using software, if I'm using a pen and paper, it does not matter. I will write down the ticker symbol. I will write down what I'm looking for in that ticker. Am I looking for options? If I'm looking for options, what are my contract strikes that I'm interested in? What are my entry points? What are my stop loss? What's my expiration date? I write all of that down in the notes. And so when I come back later, I can look at that, and then I can look at the asset, and I can see if it has met my criteria for entry. If it has, I trade the plan. If it has not, I don't do anything. Trade the plan, plan the trade. Plan the trade, trade the plan. All right? When you do this, it helps you think more clearly. When you are in a trade and you did not plan before you entered the trade and things start going south, your mental state, your psychological state deteriorates. You become more emotional, all right? Less cerebral, less cerebellum, meaning less thinking, less cerebrum, more cerebellum, meaning less thinking, more emotion. You don't want to use the emotional part of your brain. You want to use the logical part of your brain when you are trading. So write down your plan, trade what you wrote down without exceptions. That way, there's no possible way for emotions to come into check. All right. So what if something unexpected happens? Let's say you traded your plan. You planned your trade and it just didn't go as expected. Well, here's the thing. With experience, you'll learn about all the possibilities that can happen in a trade. All right. So that's just part of this stock market that you have here. You're going to have to deal with the experience curve, the learning curve. But with experience comes knowledge about what you can expect to happen to an asset or to overall market conditions. And so that's more information that you will be able to use to put into your plan until you get to the point where nothing really is going to happen that is going to be unexpected for your plan. All right. Now, here is the thing. Even if you don't have experience, I'm going to help fast forward you a little bit. All right. I'm going to share with you some things that should be avoided, whether you have experience or whether you don't have experience. All right. One of these things is going to be averaging down. All right. You do not want to ever average down. That is a very expensive mistake that can destroy your portfolio quickly. All right. Averaging down is also known as down cost averaging. It's where, let's say you buy something for 100 and it falls, and then you buy it again at 85 and it falls, and then you buy it again at 70. No, you're adding to a losing position. There is no need to down cost average unless A, or number one, it was part of your plan, or B, you are doing a true long-term investment. I cannot say how many times I've seen people get into something and they become, quote, long-term investors because what happened? They got into something planning to only day trade it. They only wanted to be in there for a day, 2 days, and it ended up falling and they averaged down. And then it fell and it averaged down. And then it fell and they kept averaging down with the thought of, oh, you can't lose if you don't sell. Okay, bag holder, whatever. Do not average down. There is something known as scaling in. Scaling in needs to be pre-planned. If it is not pre-planned, you are cost averaging, you are down cost averaging, and that will destroy your portfolio if it is not planned and if it is not a long-term investment for something like an IRA or a 401k. And only certain assets should be down cost averaged. You shouldn't be down cost averaging on a penny stock. You could, however, be down cost averaging on something like the S&P 500. Now, again, I'm not your financial advisor. You know your plan, but in general, you do not want to be down cost averaging. And that leads me to the next thing, chasing. Like I said, a lot of people have trades where they only wanted to be in for a day or two. Why? Because they saw an asset move up substantially, or they went short and because it fell substantially and then it spiked up and then they averaged and then they kept averaging. No, you can't do that. So chasing is when you buy something after it has already made a substantial move. If you chase, you are very likely to end up holding the bag. Not the money bag. No, the bag holder bag. And I will call you out on it. If I know you, if you're on StockTwits and I see you being a bag holder, I'm going to let you know about it. All right. Now, what exactly is chasing in simple terms? Let's say you see a stock, like, I don't know, recently HKD. HKD shot up and it kept shooting up. And it went from something like $12 to $2,800. But each day it would jump up like $300. And then in the same day, it would lose a lot of that value. And it eventually went from $2,800 back down to like $60. Someone is holding the bag above $2,000 all the way down to $60. You do not want to be that person. All right, so do not chase. Now that is an extreme example, but there are other examples where something might go from $20 to $40 and people chase and they get stuck holding the bag at $30 as the asset falls back down to $22 or something like that. You don't want to chase. Hey, here is your friendly reminder to subscribe, like, comment, and share this video. All right, subscribe to the channel. It helps us. It encourages me to keep on bringing you this content. So subscribe, like, comment, share, follow on StockTwits. The link is in the description. Thank you very much for the support. All right, another thing that you want to avoid as a rookie or as anybody trading the stock market is imitating others. All right, you need to be yourself. Only you and your financial advisor, which is not me, know your financial situation. All right, only you and your advisor know your portfolio. You need to trade in a style that is good for you, good for your portfolio. All right. Do not imitate others. If someone is a high frequency trader and they're successful, that might not be right for you. If someone only shorts penny stocks and they're successful, that might not be right for you. If someone trades futures, that might not be right for you. So trade what fits you. All right. Do not listen to the masses on social media. All right. Social media is full of rambling idiots. I'm just going to let that sit for a little bit. Wow. Social media is full of rambling idiots. All right, but they also have some educated people on there and experienced people on there. So do not listen to the wrong people. You, and again, your financial advisor, your licensed financial advisors, are the best traders for you. It's okay to use social media for advice on a decision you've already made, but be sure that you're listening to the right people. Listening to the wrong people can be costly. Another thing that could be costly is overtrading. Overtrading is when you pick quantity over quality. You're doing too many trades in one day. Just because you can do it doesn't mean you should do it. And that brings me to the mystical pattern day trading, PDT. I used to think PDT was a detriment, but as experience came, I realized it actually is a benefit because overtrading does exist. PDT protects you from overtrading. With that said, there are ways to get around PDT. We won't get into that in this video, but overtrading is still something that needs to be monitored and not done. Do not buy options that are too far out of the money and with not enough days remaining until expiration, or DTE. All right, this is YOLO. You only live once trading. All right. You want to buy options. You want to buy options that are in the money or at the money. All right. If you buy an option contract that is far out the money and has a close expiration, something like a weekly contract, or if you're trading the indices, the majors, SPY, QQQ, IWM, for example, you could get sub-weekly contracts. Those are the contracts that expire Monday and Wednesday, as well as on Friday. You do not want to get far out the money contracts in those situations because you lose so much value so quickly. All right. This is hazardous for your portfolio. It can destroy it very quickly. So buy contracts that have good value, something in or at the money, something that's 2 weeks, 1 month, 3 months with expiration and time for your position to grow. And don't be afraid to take profit when profit is there. All right. Do not blindly follow alerts. I used to be the person that would be on my phone waiting for it to buzz. And as soon as it buzzed with an alert from somebody I followed, I would just blindly hop into the position without even looking at the chart. Just buy. And plenty of times I lost money. And there are people on StockTwits, and I won't name them, but they're pump and dumpers. They will get into the position before you. They will, and they do this with low float penny stocks. And here's the thing: they have thousands of followers, thousands upon thousands, talking double digits, almost triple digit followers, and they will get in the position before you. They will alert the position. Their followers come in and start buying the stock. It's a low float penny stock, and it causes the price to skyrocket or to climb up. So it goes from something like $2.20 to $2.24, $2.26. Then that person sells their position and they've made profit just off of their followers coming in and pushing the price up. And they have enough money where that 3% increase could be thousands of dollars for them just on that. All right. So be aware of blindly following alerts, because sometimes they are not for your benefit in full. Trading low volume tickers. Liquidity is important. What does that mean? You buy something. Who are you going to sell it to? If you watch sports and you watch Undisputed on Fox Sports 1 with Shannon Sharpe and Skip Bayless, Shannon Sharpe always said he bought him a car, and in the seat he had custom engraved his jersey number. All right, 84. And when he went to sell it, he couldn't sell it easily because no one else was attracted to the number 84. The vehicle had low liquidity because who was going to buy it with it covered with the number 84 all over the place? You have to buy something that someone wants to buy as well. So when it comes time for you to sell it, you can do so. That's liquidity. If you're buying things that don't have liquidity, you cannot sell them easily. All right, this is common for options. You might see an option that has a bid of 125 and an ask of 160. If you buy for the ask, you're in the hole immediately because 125 is nearly 25% lower than 160. All right, it's about 23% lower. So if you wanted to sell immediately, you would have to take a 23% loss. Who wants to do that? I certainly don't. All right. If you want to see a real world example, look up ticker symbol AVGO, AVGO. AVGO has the biggest spreads for options consistently that I always see. All right. You can have a contract with a bid of 960 and an ask of like 1180. All right. It's very difficult to trade options on that ticker. Low volume is not good for trading. Be careful of that. Neither is trading with too much leverage. All right. Leverage or margin is a very effective tool. Think of leverage with, in real life, with a wrench or a crowbar. It allows you to do more than what you could normally. All right. You can lift things more than what you normally could when you have leverage. Well, it works in the stock market the same way. When you have leverage, you can trade more than what you actually have in your account. You could put in 100 and you can use 5 times leverage, and now you have 500. But that means your losses and your gains will be greater. So if you gain, all is well. But if you lose 5 times more impactful. Your loss is 5 times more impactful than what it would have been. And cryptocurrency is most notorious for this. You can get cryptocurrency assets with 100 leverage. That sounds great for you if you have a small account, or not. Not really. Because let's say you put 100 in, $100, and you trade on $100 leverage. 100 times leverage. Well, now your $100 has become 10,000. But a 1% move against the direction of your trade means you lose all of your money. Just 1%. So do not trade with a lot of leverage. Make sure that you know the risk before using leverage. And lastly, learn to walk away on a small win or a small loss, or really any size loss, but certainly learn to walk away. All right. You see the Kenny Rogers lyrics there on the screen. That's what you need to understand. All right. If you do not learn to fold, the market will fold you. So in conclusion, be mindful of your emotions. All right. Develop a plan for trading and write it down for each trade. Like we just said, if you don't learn when to fold, the market will fold you. Well, on a good note is if you learn to plan, you can help prevent that. You should put your exit plan in your trade. That's learning when to fold. You should put your entry plan in your trade. All right. All of that should be a part of your plan. Your exit plan should include when to leave with profit, when to leave with a loss. All of that is important. Be aware of your common mistakes and avoid them. It is important to know what is a mistake. People might not think overtrading is a mistake. It is. So it is important to be aware of common mistakes like those listed in this video and to avoid them. If you think that you might forget them, write them down, put a sticky note right next to your computer or wherever you use to trade. That way you can remember it. All right. So I want to thank you very much for watching this video. Please do not forget to subscribe if you already have not. Like the video, share it with your friends, leave a comment, follow me on StockTwits. The link is in the video's description. Have a great day and happy trading.